Hi everyone, and welcome to the Buffett and Beyond weekly ETF video letter, and this is for Saturday, June 3rd, 2023, and these methodologies are based on the book Buffett and Beyond, second edition by Dr. J. Belmonte and published by Wiley Publishing. And remember folks, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And now let's start with the semiconductor ETF, and folks, this is where it's been, hasn't it? And this is where we were last week, right up in here. And you can see this past week, even with the market coming to life, we did not gain any ground on the rise from last week. Of course, this was a big move up and a big gap in here. So it's just sitting here. And if we draw the line all the way across here, you could see this big double top in here. And so we just have to see what happens next week. But this was pretty nice. And, well, we're going to all go over the stocks in just a second here. Now, these are the 5 stocks that we put in, or we selected for this ETF. This is the semiconductor ETF. And, of course, our theory is, as you all know, that we, rather than pick an ETF for the most part, we would rather take the top 5 stocks in those returns, and then we just about every time outperform that ETF. So let's see what we're doing. And this is as of this year, and we can see the XSD, which is the semiconductor ETF, up 24.6%, very, very nice, while the S&P is up 11.4%. So the semiconductor ETF is doubling, more than doubling the S&P 500. But let's see how our 5 top stocks have done. Well, yeah, they've done at 64.9%. And folks, if that's not big enough for you, we were actually up 5 more points last week than we are this week because of that little top that we've seen, and the market, or this particular ETF, trying to break through that double top that's sitting right there, providing overhead resistance for us. So yeah, the S&P up 11.4%, the XSD up almost a little bit more than double that, and then the top 5 stocks are up about 5 times more, or 6 times more than the S&P 500 index. So yeah, very, very good with these top stocks in this particular ETF. Now let's look at the technology. We looked at the technology ETF last week, but we didn't look at the stocks in them. And you can see this blue line is a 50-day moving average, and we are way ahead of that 50-day moving average. And usually what happens when this kind of space develops is we get a reversion back to the mean. So look in here how far above the 50-day we were, and then it reverted back to the mean, almost exactly to the penny, back to the 50-day moving average. Over here, we were way ahead of that 50-day moving average, a big space in here, and it came back and eventually met the rising 50-day moving average. So this is kind of what we're expecting in here. We think both the technology and the semiconductor are going to take a rest, while the rest of the stocks, the other 490 stocks or so, catch up to the S&P 500, because there's a lot of stocks that are lagging right now. And when we look down here, we can see that this is a very, very nice move up. So this indicator pointing up, it's our intermediate term indicator, doing very, very nice. And also over here, these brown lines are, or represent, the volume when the ETF has closed up for the day. And now I'm recording this before the close on Friday. That's why this line right in here looks very, very small. But you can see that the brown lines, or the gray lines, I should say, really have the momentum going for them. So when the market goes up, the volume is there. When the market goes down, the volume really lightens up, and then we come back to going up again, and these gray lines represent that upward volume. So when we look at the top stocks, now remember, a couple of weeks ago we talked about this, and we said we're taking paychecks out of this portfolio, because when we went back and we looked at it, we took a double take and a triple take on it. We decided that it does not outperform the S&P 500 over the long term, close, but it doesn't outperform it. And so therefore, we're taking it out of our top. We actually had 6 stocks in here, and now we have 5. So with the XLK, the technology ETF, up 34%, up 3 times the S&P 500, and our top 5 stocks are up 41.5%. But if you counted paychecks in there, because we took it out a couple of weeks ago, this number would be a little bit lower. This would be about 38%. So the top 5 stocks, once again, are outperforming the ETF itself, and a 41% return for the first 5 months of this year ain't too bad, folks. So we're keeping an eye on this one too, because again, remember well, let's go back to it. The reversion to the mean, we think, is going to take place in here, and that means it doesn't necessarily mean the semiconductor or the technology ETF is going to go down. It just might go flat for quite a while until the 50-day catches up to it. But I think we're going to see some backing and filling in here. There's a couple of gaps that might have to be filled, and they're small gaps, so it's nothing big to worry about. It's just a rest time. And then we're going to look at the healthcare sector, and there's something that I want to bring out in this healthcare sector. And we talked about this last week. We said it looked like this healthcare sector wanted to start moving up, and we looked at a few things, and we said it's not doing it yet, but this week it started. So this was Wednesday when it finally turned around on big, heavy volume. And of course, so much of this rally that we're seeing, if not all of it, has to do with Congress getting its act together and coming up with the debt ceiling, and which means the country's not going to go broke. I think for the next 2 years, they've got it settled out for a little while here. So we're looking at this indicator here, or we're looking at the candlesticks here, and we are coming back up, and we're meeting the 200-day moving average here. First of all, when the 50-day crossed above the 200-day, that was a good sign. So that started giving us a little hope in here that this thing was getting ready, or this ETF was getting ready to move. And then it dropped quite a bit in here to kind of fill this gap over here. Yeah, maybe that's what it was. And then all of a sudden it did fill that gap, and now it's starting a move up. Now the healthcare sector has been down for the year. It's been hurt pretty hard. If you think about it, with COVID and a lot of people still wearing masks, not a lot, but enough, so that fear is still there. And when COVID was around and everybody was getting it, people did not want to go to the hospital, because that's where all the sick people with COVID were. So why would you go to the hospital if you had COVID, or if you think you had COVID? Yeah, you didn't want to go there. So the hospital stocks were hurt. The healthcare sector was hurt quite a bit. So we're looking at this, but one thing I want to show you here is now we have a higher bottom here. So if we draw this line right here, we have a higher bottom, and it looks like the healthcare stocks are starting to take off a little bit. Now let's look at our 5 top healthcare stocks, and folks, you could see they have not done too well. Now Zoetis is in the animal medical industry, part of the industry, and of course we take better care of our horses, our dogs, our cats, our parakeets than we do of ourselves. So this is in our growth stock, or our growth portfolio. And also United Healthcare is in our growth portfolio. That is not in the XLV ETF. I have no clue why not, but if we were going to put another stock in here, I would put the United Healthcare into this portfolio. And we went over that during the week in our daily letter, United Healthcare, and we gave a buy signal on that. It was turning around, and we put any extra money that we had in our portfolios, we put it into the United Healthcare stock, which is up very nicely from when we bought it the other day. So anyway, we are looking at the S&P 500 up 11.5% for the year, and the XLV which is the healthcare ETF, or one of the healthcare ETFs, down 4.4% for the year. Our top 5 stocks are up 2.8% for the year. So our theory is holding true about the top stocks in the healthcare, or any ETF will outperform, for the most part, the ETF itself. But of course, we're not shooting off fireworks because of this, just because we're up 2.8% with the XLV, which is the healthcare ETF, down 4.4%. And I just want to show you in this next slide, when we look at this, we are looking year to date. Black line is the S&P 500 in here, and you can see the S&P 500 is just not up very well. It's up 11% for the year. And you can see 3 stocks down here. Bristol Myers, OBV, and Centene are all below the S&P 500, while Align, which is in the teeth business, by the way, has its one product. And the reason I don't care for that stock, even though it's been in our growth portfolio, but then we took it out, it's pretty much a one big product type of company. And then you have Zoetis down here, which is up about 15% for the year. So when we look at this, we say, well, yeah, it's been hurt this year, but let's go over 5 years and see how these stocks have done. Again, black line's the S&P 500, and folks, we're looking at something. The top 5 stocks in this XLV, the healthcare ETF, it just not doing so well. So it's one of those ETFs where I'm saying, if you're going to trade the ETF at all, then you want to trade the ETF. You don't want to get into the individual stocks. Now, I mentioned Zoetis, I mentioned United Health, and they are good, but the rest of the stocks are just meandering around, and they do have dividends, which are not shown on this chart. So you're looking at something that, let's go to the next slide, you're looking at something, black line S&P 500 over the past 5 years, and the XLV, the healthcare ETF, actually right at 50% level. So I would say this, rather than getting into the XLV because it's in healthcare and everybody's excited about it, if it doesn't outperform the S&P 500, you might as well be in the S&P 500 and be more diversified. So you'd be safer to be in the S&P 500 rather than the XLV. Now, of course, we do have those 2 stocks, United Healthcare and Zoetis, that are in our growth portfolio. But as far as the rest of the stocks go, I don't see any big deal unless you're in some of those stocks for a defensive portfolio like OBV and some of the others. So if you're thinking about trading in this ETF just because it looks like it's coming off a bottom, this is very oversold down here, this indicator. So therefore, if you want to trade the healthcare sector, the healthcare ETF, in this instance, it's the XLV. If you want to do that, then forget about the individual stocks and just go with the XLV and see where it takes us, because it's about time this thing did come back to life. Again, the S&P is up 11%, over 11% for the year, and this XLV is down 4.4% for the year. So therefore, maybe it has some room to run and to make up. The individual stocks, except for Zoetis and United Health, I wouldn't go into any of the other stocks except maybe AbbVie, which has a nice dividend along with it. But as far as growth goes, no, the healthcare industry is good, but it's not outperforming the S&P 500. So, folks, remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. So with this ETF video today, I just wanted to show that there are sometimes the actual ETFs themselves are not any better than the S&P 500. We like the tech, we like the semiconductors, and there's a few others in there which we go over every now and then. But as far as the healthcare, I think you're better off being in the S&P 500, and also Zoetis and United Health are good companies. So, folks, You go out. We had a great week to start June. So be with your friends, be with your families, have a good time this weekend. Take your mind off the market, because guess what? It'll be back here on Monday, and so will we. All right, folks, have a good weekend.